Hi, this is Ken Boyd with the Accounting Accidentally website. On the home page here, you'll find hundreds of blog posts, over 300 blog posts, and if you slide down to the middle of the page, you'll find over 400 YouTube videos. This is the first of several videos on consolidation accounting, which I think is the most difficult topic in accounting. And to start off with, I want to talk about calculating the differential. And so what we're talking about here is when a parent company buys a subsidiary. So a parent buys 80% of a subsidiary company's common stock for cash on 1/1x1. So the first step is, what is the entry on the parent company's books? Well, they're making an investment, and they create an account called investment in sub. They happen to spend $316,000, and they pay cash. And the explanation for the journal entry is to recognize a purchase for 80% of a subsidiary. Now, in many accounting questions on consolidations, you have what's called an NCI, a non-controlling interest, somebody who is a minority owner in the business. So in this case, the parent company bought 80% for $316,000, but that implies something. If you buy 80% of the company for $316,000, that means that the entire company is worth $395,000. And if you take the difference between that total and what the parent company bought, the remaining 20% of the company is worth $79,000. It's a common calculation in a consolidation problem. So we have this thing called a differential. And the reason we have a differential is that the fair market value of specific assets is greater than book value. That's one reason. Or the company has goodwill created because they paid more than the fair market value of the assets. It can be one or the other or both. So in this case, the consideration, a business law term, consideration that was paid was $395,000 for the entire company. And we're going to assume that the book value of the assets that were acquired is $350,000, and we come up with that total as the sum of these numbers. So the difference between $395 and $350, the sum of these numbers, is the differential, $45,000. And the differential goes to fair market value of specific assets or goodwill, one of the two. So the way I keep this straight is to set up something like this. Okay? If you slide down to the bottom of the page, we're going to assume that there were two assets, inventory and buildings, that had fair market value above net assets totaling $20,000. Okay? So that the fair value of the assets is $370, the book value is only $350. So that $20,000 difference is stated up here. Here's fair market value of the assets, here is book value, the difference is $20,000. That is part of our differential. To get up to $395, which is the value, fair value of everything, the remaining $25,000 difference, if I click on here, is posted to goodwill. So there is a new asset account called goodwill that's created. So what we talked about was, in consolidation accounting, how to account for the differential. If you're studying consolidation for the CPA exam or for an intermediate accounting class or advanced accounting, you can go to the feed here of a conference room and you'll find that we are teaching live courses. This one happens to be 5 biggest topics in the FAR test. Chats, discussions, articles, and live courses to study accounting. Thanks very much for watching. We'll see you next time.